For the type of business model he is planning on setting up, Mr. Tunde would need to approach a bigger financial investor. But he sees that he would require a more comprehensive business plan that would attract the investor to fund the project. He once again asks Mr. Greco to show him how he can go about this. Welcome to Investment Analysis for Solar Projects.
Welcome to today's webinar presented by Greco Academy. Today's webinar is an introduction to investment appraisal for solar projects. Today's webinar shall be presented by yours truly, Tay Wada, the Head of Finance at Greco Power and Energy, also the lead power sector consultant, as well as the solar finance expert. Today's webinar shall look at a brief introduction to solar project investment analysis, evaluation of solar projects, conducting financial analysis, risk and uncertainty in investment appraisal. And we shall close out with a brief case study looking at how some of these tools can be put into practice. So solar projects, these are becoming a very conventional asset. Pretty much in all our towns and rural areas, siting solar panels on rooftops is becoming a normal sight. These projects are becoming very, very conventional and a lot more acceptable to investors, that they've become more comfortable with the long-term nature of these investments. And also companies in the commercial and industrial space are also looking to take on the advantages of renewable energy. Your major oil companies are all investing billions of dollars into clean alternate energy as the whole world makes a transition in that direction. Nigeria signed up to the Paris Agreement, and since then has been taking strides to incorporate renewable energy into its energy mix. As a matter of fact, through the Renewable Rural Electrification Agency, it has embarked on electrification of its federal university institutions. This is an image from Alex Ekwema University in Ebonyi State, where a 1 megawatt solar PV system has been installed with battery storage. Now, when we talk about valuation, this is just a simple process of estimating what an item or a project is worth. And what are the key reasons why we bother about carrying out valuations? It's so that we can obviously advertise our project to would-be investors so we can get funding to get our project off the ground. Also in the situation where there are mergers or acquisitions, one company buying out its competitor or buying nominal valuation that it's putting on such a company is a true reflection of what the firm or company is valued at. Obviously, in the situation of financial reporting, you have your statutory requirements for tax purposes. Your requirements that also require you to be able to adjust the valuation of your assets as the lifetime of the asset unfolds and the project and the items depreciate. It's important that these are reported accurately, and also to make sure that the liabilities that you hold in terms of debt finance from financial institutions are also reported accurately on your balance sheets and income statements. But in today's webinar, we shall mainly be looking at valuation for investment analysis purposes. Now, what are the main methods out there? Very popular method. It's one of the first ones that we generally hear investors talk about when we are in the PV solar projects. Internal rate of return and the net present value are also two very important measures that actually take into account the time value of money. And last but not least is the levelized cost of electricity. Basically works out what the unit cost is of that generating asset. Okay, we shall try and look at one of all these individually, try and put a little bit more like behind them. So the first one we should look at for conducting our financial analysis would be the payback period. As I said, this is one of the most requested measures to see the feasibility, the economic feasibility of your PV system. Why is that so? Because it's a very simple measure that lets you know how long it takes for the capital investment or the total investment to be recouped. I.e., if you invest $1 million and the project is paying back $100,000 every year, simple mathematics will let you know that the payback is going to be in 10 years. So that straight away, the investor will know whether that is a project they want to have a second look at. Obviously, in a situation where you have the payback period being longer than the lifetime of the project, that's a no-no for any investor. It's a very simple calculation. As you can see from this formula here, you take the initial cost, so all your capex costs, project development costs and whatnot, you put that down as your initial cost, and then you divide that by the total amount of energy that you expect the system to produce in a tariff that you expect to be paid. Obviously, if you're doing your calculations in Naira, it should be Naira per kilowatt hours. And you would multiply that, obviously, by the number of years that you expect your system to be operational, i.e. 5 years, 10 years, 15 or 25 years, depending on the nature of your project. And you make any deductions for your operation and maintenance costs that occur throughout the year. The project, the disadvantage of these payback system is, one of that it doesn't take into account the time value of money. But having said that, as I said, it's a very attractive calculation because it's straightforward, it's easy to understand, and it allows investors make a very quick decision of whether to look any further into a project or to simply just move on. Obviously, the shorter the payback period, the more attractive it is. But as I said earlier, it does have its limitations, one being that it fails to take into account the time value of money. It also doesn't take into account the escalation of energy prices, the different variations that can happen with regards to currency fluctuations, and all those other factors in the market as well. So when we talk about time value of money, well, what do we really mean? I mean, it's, in a simple concept, basically means that the purchasing power of 100 Naira today is going to be greater than the purchasing power of 100 Naira in a year's time. And reason being is not because of one particular currency or the other. It is just because of things like inflation, market risk, opportunity cost, things like that naturally exist year on year. Obviously, your banks are paying you interest for saving money with them. They're charging you interest for borrowing money. So all these things affect the value of money over time. And ignoring the time value of money can seriously lead to an underestimation of a project's real value. And then obviously that would also affect what the real payback time would be. In the past, what I've seen some investors do is actually still do a payback analysis, but what they do is that they discount the cash flow so that you have a more accurate representation of the payback, taking into account some of the time value of money. But all this talk about discount, let me actually try and shed a little bit of light of what we mean by discounting. So I will bring in the concept of compounding interest. Okay, so as I mentioned earlier, I mentioned briefly about opportunity cost. So what are these opportunity costs when one invests in a large project? I mean, this is basically the cost of your capital, the alternative of what you could have been doing with your money. So the alternative, instead of me putting money into your project, would have been to buy government bonds or put it into a fixed savings account that would have given me a fixed return at a set date, and that would have been secure come rain or shine, I'm going to get that payout. However, putting it into a project, there are so many anomalies. There could be, even natural disasters that could actually just spell the end of the project and the end of all my investment. However, with regards to government bonds and bank investments, I'm shielded from those kind of disasters. So the minimum rate of return is what any investor would expect back on their money. And we can also refer to that as the cost of capital interest rate. Or in this case, we're going to use the term discount rate. For those of you that do not have an economics or finance background, you might just be hearing this for the first time, but this is a normal expression in the finance world. So let's take a quick example so that you can get a better understanding of how this works. So with the example I'm going to give you first, we're going to look at it from a compounding point of view as the interest compounds, and then we're going to now take it into the reverse because that's what we are trying to get at. Okay, so suppose we were to invest 100,000 naira in a risk-free security that pays a return of 10% at the end of the year. What would be the value of our investment over 4 years? Okay, so I put together a very quick table that basically does the whole calculation a bit manually. So we have year 0, which is right now. We have our total investment, 100,000 today. We put it in. At the end of year 1, we get 10% paid on that. So we end up with total investment of 110,000. And so likewise with the compounding interest, we have the same for year 2, year 3, and at the end of year 4, we have 146,410 naira. Obviously not a bad table to put together to work out your calculation. But then what if you wanted to find out what the payback was going to be in year 50? You would very quickly run out of space on your paper, and basically there's a cleaner way of doing it. So we have a little formula here that I'll share with you, which is basically the future value N, the N there indicating the year that you want to know. So future value in year 2 is equal to the present value, that's V0, multiplied by 1 plus K, which is the interest, which in our case is 10%, all raised to N, which is the year that we're interested in. So let's take a quick example and work out for what the interest on our 100,000 would have compounded to in year 2. And I put a quick formula here together for you, interpreted as 100,000 multiplied by 1.1 squared, and we work out that it's 121,000 naira. Okay, so that's a very simple, straightforward formula that you can apply to find out what the interest would be. What the total investment value would be in the future when you have compounding interest. Okay, so our table again. Now let's try and do things the other way around. So we have a nice formula letting us know what the future value will be. Now let's try and make D the subject of the formula. So we flip this formula around, and we have the present value equal to the future value of whatever year that is, divided by 1 plus the interest rate being 10% in our case, all raised to the power n, which is, whichever year that is. So likewise, using our example of year 2, let us work backwards. So we know that we're going to receive a payment of 121,000 naira in year 2. We want to know what is the present value of that 121,000 today. Okay, so so by applying this equation, the calculation for 101,000 received at the end of year 2 can be expressed like so. Okay, so as we can see from this, it basically takes us back to our original 100,000 naira, which is the present value of the money that we have in hand today. Okay, so this is basically how you go about using this discount factor and how you go about doing discounted cash flows. So you apply this to all your expected revenue from tariff collection over the lifetime of your project. And depending on, obviously, we're using 10% here because 10% is what we have in our given example. When you work out your interest rates that you're getting from the bank finance you have, you work out what your company equity rate is, then you work out what your weighted average cost of capital is, and then you can apply that percentage as your discount factor. So these discount factors are mainly used in the net present value and internal rate of return calculations. The net present value is basically a calculation that allows you to know what is, as the word implies, or as the name implies, what is going to be the net present value of all of the lifetime of the project. So all the future cash flows that we're expecting over the lifetime of the project, their present values, what is going to be the net of it, meaning when we take out the cost of investment, the cost of the project, the CapEx, the OpEx, we remove all those, what is going to be the net, what are we left with? Ideally, what we want to see is we want to see a positive number, naturally. A negative number indicates that, the future value of what you're getting is going to be less than what you are investing today. So obviously, that spells sign that there's going to be trouble ahead for you. The formula is very straightforward, as I've just explained. It is the summation of all your future cash flows divided by 1 over the interest. 1 plus your discount factor rate, all raised to the time t. Here we explained R as cost of capital, but as I explained to you, these are interchangeable terms. Even in some cases, you might see the expression WACC, which stands for weighted average cost of capital. It just depends if you have different financing sources. It's a very, very useful metric because, as I said, it takes into account the time value of money. It also you can also adjust the NPV calculation. So in different years, you can actually apply different discount factors. So if you have a situation where you're taking a bank loan first for 5 years, and then you expect that at the end of year 5, you'll be taking a different finance instrument that might give you a more favorable discount rate because now obviously you have an asset behind you. So there might be different anomalies coming into play that might adjust your discount rate over the lifetime of the project. And NPV calculation allows you to adjust that. Obviously, when you're doing your NPV calculations, I wouldn't imagine in this day and age that anybody is doing it with pen and paper. I would imagine that you're doing it on Excel. And in that situation, Excel already has the formula built into it. So it's a lot easier to obviously carry out your NPV calculations. As I said, NPV project that yields a negative NPV is one that basically should be avoided, whilst one that gives you a positive NPV is one that is worth looking at further because it's one that's basically going to create value for the investment as opposed to. Now let's quickly move on to the internal rate of return. This is a method of calculating basically an investment rate of return. The term internal refers to the fact that the calculation excludes all external factors. So it's not going to bring in things like inflation, cost of capital, all those finance risks. But the internal rate of return, basically, it's almost looking at it from an equity point of view. So the equity shareholder point of view. And basically, in a nutshell, it's a percentage. It should be presented as a percentage as opposed to NPV, that is a nominal figure. The internal rate of return is basically the percentage at which the net present value becomes 0. Okay? So what is the formula for internal rate of return? Unfortunately, there isn't actually a formula per se. It's normally a trial and error thing. As I said, it's the percentage at which the NPV is 0. So what we normally do is we do a little bit of explanation. Once we work out that we have a positive NPV, we then have to then go and reduce this discount factor to be able to get we then have to, if we have a positive NPV, I beg your pardon, we have to increase the discount factor so that we can get a negative NPV and then extrapolate and then know that it's the discount factor in between the two that is going to give us our zero. Likewise, if you have a negative NPV, what you want to do then is reduce the discount rate to be able to get a positive figure. Okay? So let me just say that one more time so I don't confuse anybody. If you have a resulting positive NPV, then you need to increase the discount factor to be able to get a negative NPV so you can do your explanation to get the discount rate at which NPV will equal zero. And then you can apply this formula here when you have your NPV positive and NPV negative. And you can work it out that way. But obviously, as I said, I don't expect anybody to be doing these calculations on pen and paper today. I expect that calculations will be done on Excel. And obviously, Excel, as I said, has these formulas built into it. Nice and straightforward. You just put your cash flows and you type in IRR, and simple as that. Excel just works it out for you. So better to rely on Excel for this one. Now, what are some of the things or guidelines that we need to bear in mind when we use NPV? As I said, it basically works out what the rate of return is on the investment. Now, if the the internal rate of return is lower than the discount factor after you've calculated it, then obviously you need to work away from that project, because basically it's telling you that that project is going to make less than what the investors are prepared to stomach. And then it's also telling you that your cost of finance is going to be higher than what the project is going to return. So you always want to be looking for a project where the the internal rate of return is above the discount factor. So the internal rate of return indicates the annualized rate of return for a given investment and a given expected cash flow. So no matter how far into the future is, you can still work out your internal rate of return. The disadvantage of using the internal rate of return method is that it does not account for the project size when comparing projects, as cash flows are simply compared to the amount of capital outlay. So what that means is that if you're comparing projects that have different capex requirements, it might report both projects with an internal rate of return of 20% or 25%, but it does not take into account the fact that you are having on one project maybe investing double the amount of capex. It might not take those kind of factors into account, and obviously the additional risk by exposing more capital to a particular project. It doesn't take all those into account. And then also, as I said, over the timeline of the project, you might have different costs as you bring in different finance mixes over the long term of the project, especially when we're talking about a project that is running for 20 to 25 years. You wouldn't expect to just have one finance option that is going to cover you for 20 to 25 years. Such tools do not exist. Even mortgages, when you take a mortgage on your property, they don't give you one rate that basically lasts for the lifetime of the mortgage. These rates are normally for a few years, and then you always renegotiate and do a fresh mortgage arrangement. The same thing when it comes to project financing as well. last but not least, the levelized cost of electricity. This is a measure of the average net present cost of electricity generation from a generating plant over its lifetime. The beautiful thing about levelized cost of electricity is that it allows you to compare different electricity generating assets. So it allows you to compare solar against the hydro, against the gas combined, or whatever different generating nuclear, whatever different generating assets you have. The advantage, it has several advantages besides that as well. It also does take into account the time value of money, as it also applies the discount rate as well in working this out. Generally, the formula is, it might look a little bit complex here, but it is really, really straightforward. Normally, by the time you've done your MPV calculations, where you've done your discount cash flows, you basically just take your total cost, or your investment cost, your OPEX cost, your operation and maintenance for the lifetime. If you're going to have any fuel expenditure, especially if you're doing a hybrid project that has a diesel generator as well, you put all those costs in together, and then you apply the discount rate. You divide it by the discount rate that you have. And this is actually a plus. I know it looks like a minus, but it's 1 plus the discount rate on both the upper and lower axis. For both the numerator and denominator, I meant to say. And what you want is you want to divide it by the total amount of energy that you expect to generate over the lifetime of the project. And then that way, this will now give you, the resulting figure it gives you is a cost figure, and how much it costs for 1 unit of electricity based on all your costs. So in this one, it doesn't take into account any revenue or any tariff that you're hoping to get or anything like that. It basically looks at all your costs you're going to incur. So obviously, the more prudent you are in identifying all the costs that you expect to encounter over the lifetime of your project, the more accurate this final figure is going to be. So as I said, it's the minimum price at which energy must be sold for the project to break even. So yeah, this is your cost price basically. So levelized cost of electricity typically are calculated over 20 to 40 years and are given in units of currency per kilowatt hour. So either dollar per kilowatt hours, euros per kilowatt hours, even naira per kilowatt hours, depending obviously when you're presenting your final figures, who your investors are. Obviously, if you're dealing with a Nigerian financier and all the finance is being done in naira, there's no point of obviously depicting your figures in dollars or euros. When comparing levelized cost of electricity for alternate systems, it is important to define the boundaries of the system and the costs that are included in it. So what I mean is, you want to, if you're going to also be including transmission lines and distribution systems into your system design, and obviously you're expecting that cost has to be recouped over the lifetime of the project, you need to incorporate those costs into your levelized cost of electricity calculation. You can't just look at just the capex for the solar plant itself. You also need to take into account things like research and development, your environmental impact assessment, all taxation, all those costs that you incur pre-development. And you need to figure out, are you going to be passing those costs on to your investors, or is that something that you as a company are going to absorb as your own development costs separate from the project? Okay, so those are things that obviously as an individual company, from company to company, these questions will be answered differently depending on how you are set up and how you are developing your project. If you are just developing projects to sell, obviously you will be presenting those figures differently. More than likely you would not be putting your development cost into the project itself, because you want the project to be looking as attractive as possible as a standalone, as that's what you'll be selling with all the other work already as add-ons for, to make an easy transition to a would-be developer. And also, so all these other costs like public health, environmental damage, water that you're going to use for cleaning or PV systems, the impact that it might have on the environment, especially when you're talking about very big systems. If you're only talking, 100 kilowatts, those kind of systems, you might not really have any real impact to talk about. But when you're talking about huge projects, 1 megawatt, 3 megawatts, that's going to require you to cut down quite a bit of greenery, take away the habitat of some wild animals and birds, then you have to start really considering what impact it has on the environment. And don't forget that this site is going to be cleared and, not going to have any return of green cover for, maybe 30 or 40 years. So these are things that you need to also take into account, or might want to take into account in your calculation. Obviously, all these costs that you take into account, additional costs that you take into account, you will normally state this alongside as well when presenting this information or this final figure to your investors, or would-be investors, I should say, so that they have a more holistic idea of what it is that has been calculated into the levelized cost of electricity. And in the case of Nigeria, where you have certain government subsidies, like for the education program, I believe EEP, the market energizing economy, and those kind of programs that when you build projects, you can get part of the cost paid back to you in forms of grants. Are you taking those into account when you're working out your levelized cost of electricity? So those are all different questions that you need to be asking yourself when you are applying this formula, and what element of cost are you actually putting all into it. Okay, so as I said, this is just a brief introduction, so we're not going to go into any great detail. If you obviously want to learn a lot more about these project appraisal methods, we do offer paid-for courses that you can obviously subscribe onto. Risk and uncertainty in investment appraisal. Apart from the investment analyst looking into how stable cash flows will happen for the proposed lifetime of the project, it is also important to identify, the risk and uncertainties that might occur. Like what will be the situation if the project is not completed on time, if it takes longer? Are there going to be any additional cost implications, or what's that going to affect in terms of projected cash flows? Are there any risk factors around the operation of the plant? Is there technology transfer? Are you going to be able to leave the plant in the capable hands of the locals to operate? Are you going to have to bring in foreign staff to operate the equipment? In the situation of where you're ordering equipment that is coming from abroad, and in terms of where a project is awarded, between when the project is awarded and when the project is fulfilled, you have a situation where you have no control over that timeline, and you might have bidded for a project in January 2019, but get awarded that project in January 2020. At which point in time, the technology that exists in the market is different from what you initially bidded. So maybe when the equipment actually does arrive, let's say you already had PV panels on ground, but when you now go to purchase your inverters, you find out that the technology has changed and you don't have inverters that are compatible with the PV array that you already had. Obviously, the chances of that happening nowadays are getting slimmer and slimmer, because the compatibility between the major PV systems and batteries are a lot better than they were in the earlier days, for instance. You have other risks like, tax, political risk. We know very well that energy prices are very political issues in Nigeria. and you need to be careful when setting prices, especially setting tariffs for those vulnerable populations, people in the rural area. So those are things that need to be at the back of the analyst's mind. Obviously, you need to make sure that you're always carrying out data validation, cross-checking your numbers. Don't just rely on published data that was put out in the public domain 2-3 years ago. Costs and prices would have easily changed over time, so make sure that you're keeping yourself up to date with that. Also, make sure that in the case of legislation, you're keeping up to date with what the latest legislation are from NERC and all the bodies in control of regulating the sector. When you're obviously doing your analysis and you've done all your MPV or your internal rate of returns, don't just be satisfied with your initial calculated rate of returns or your initial net present value. You want to carry out sensitivity analysis. So what is this? You want to place scenarios where if your cost of capital were to change, for instance, or if your projected income were to, reduce by 5% because you had, an increase in collection losses, or you had undervalued the naira in anticipation of what was going to happen in the future, fluctuation in foreign exchange, all those kind of things. So these are things that you can do a sensitivity analysis where you actually adjust the prices, your inputs into your formula. So be it your cost inputs or your revenue inputs. You can also adjust your discount rate as well. As I said, so that would affect your cost of capital. You can also look at things like making further adjustments for inflation. So Nigeria has a pretty high inflation rate, I think roughly around 12-13%. You might want to make adjustments for even higher inflation that might occur. So two fundamental things to hold in mind when carrying out sensitivity analysis is to give insight into the impact of critical model-based parameters and to investigate the sensitivity parameters that produce most profit. So what does this mean? Basically, you want to be looking at the elements that can have the most impact. So the elements that very little change, even just a 1% change, can basically bring your project to a complete halt. So if you want to try and identify what that is it your cost of capital? Does it mean that if your cost of capital goes up by 1%, like basically the project is going to fail? Or does it mean that if your revenue drops by 1%, the project is going to fail? Or is it that if inflation goes up or your operation and maintenance cost, there might be little factors here. Likewise, there might also be factors that with little adjustment, they're going to have huge impact on your profit. So if your cost of capital were to go down by 1%, this could actually have a tremendous impact on your profits, especially on huge investments where you have a couple of $1 million invested. A 1% change is quite significant. So those are the true areas you want to really focus on, because also when it comes to management of the asset, it would allow management to really focus on those critical areas, those very sensitive areas that can rock the boat one way or the other. Okay, so that pretty much brings us to the end of today's webinar. As I promised, we're going to close out with a case study. This case study has been taken from a project it was a field study that was carried out by L.COE. L.COE Germany are a consultancy firm. They are recognized worldwide. They are huge experts in renewable energy projects. They have done a few studies in Nigeria. They've also implemented a successful project as well. And this is from one of their such studies that they did in Nigeria. So they were looking at the site, and the proposed PV project for the site was to be 100 kilowatt PV, peak PV array, and they were looking at the costing of 600,000 naira per kilowatt peak. The proposed battery size was 400 kilowatt hours with the proposed size of 100,000 naira per kilowatt hour, and that gave a total system cost of 100 million. They were looking at fixed operation costs of 3.5 million naira per annum. They don't appear to have any variable cost. I would imagine that they have some, maybe their O&M has been adjusted into their fixed operating cost, since that's a recurring cost. So what they have for PV generation, they're expecting it to yield around 2,000 kilowatt hours. They're looking at a performance factor of 82%. So obviously this affects the efficiency of the equipment. The generation, the PV generation will be adjusted to that 82%. Okay, they're looking at the lifetime degradation of 7%, so that will be on the PV system. So obviously this, you need to adjust the efficiency of the PV system as it degrades over the lifetime of the project. I feel that degradation is a little bit on the high side, but it is what it is. Okay, the duration of the project, they have stated here, is 25 years. And they're looking to split almost a 50-50 split between equity and debt. Yep, they have 50% gearing. The initial loan tenure is for 5 years at 9%. They've given the area 10% inflation rate. Well, okay, it's 2017, so yeah, it's probably about right. So they worked out the discount factor of 15%. So obviously, to work out, you can straight away tell that this discount factor they're using is a weighted cost of capital, a weighted average cost of capital, because interest rate and inflation rate are both below 15%. But what they're more than likely taking into account is the cost of this equity. And cost of equity is always higher than debt. It is better, generally to use bank money to do a project than to use shareholders' money, because shareholders always have higher expectations. They always expect higher returns for, using their capital. Okay, the PV business model itself. So how are they shaping up? They're expecting consumption via PV battery to be 55%. They expect battery losses of 10%. Direct PV consumption 40%. So imagine during the peak radiance, during daytime consumption. And then in terms of tariff, okay, they're not using a flat tariff. They've actually divided their customer base. They have an anchor client here where they expect, I believe, majority of their sales to occur. They put 50% on the anchor customer at 140 naira. They have another customer base where they put 30%. These are on commercial customers, the 120 naira, and then households as well on the same tariff of 120 naira make up the last 20%. Okay, they allow for price escalation at 7% per annum. So what that means is that each year they expect that they'll be able to increase the price by 7%, which is obviously makes sense in line when you take into account that you have a double figure inflation as well. Okay, so just looking at the figures that they have provided here, this looks like a pretty interesting project, 100 kilowatt. The way they've divided their projects, you can see they have been very thoughtful in terms of trying to shield the low-income earners here. And their anchor client is probably a well-established business. Okay, Okay, so from the results here, we can see that they have a positive NPV. The NPV is almost 2.2 million naira for the lifetime of the project. So that means the present value of this 100 million naira that they're investing today, the present value that this 100 million is going to bring them back over the 25 years of this project in today's money is going to be 20.2 million. Okay, that is basically what that net present value calculation means. So basically saying that your project is worth 20% in effect of your capital deployed. And I'm not surprised because you can see the project IRA internal rate of return and the equity internal rate of return are pretty much close to 20%. So that's what I would expect as well. The equity internal rate of return is usually a little bit higher than the project internal rate of return, just simply because, as I explained, equity is more expensive than debt finance. So that's the only reasoning behind it. And payback period for this project is almost 13 years. It's 12.9. So this is also it's an interesting. I know that a lot of finances that we have dealt with as a company with generally not very. They prefer anything between 5 and 8 years. 13 years for them is too high risk, especially for an investment in Nigeria, because Nigeria is considered a high risk market, where you have high risk occurring between during the transition period from one administration to another. So anything that really goes over 8 years, a lot of investors will shy away from it. That's why also a lot of investors normally time their investment when a new government is coming in. Generally don't like taking on projects when it's coming to re-election or the end of an 8-year period as a 2-year tenure, because of the uncertainties that occur. Although obviously Nigeria has been pretty fortunate since the return to democracy in 1999, these transition periods have been pretty smooth. So we haven't had, the kind of instabilities that, have been the reality in the past. Anyway, so as I said, we're just going to go through this very briefly. If you want to practice on your own, you definitely have the results. So you can go on Excel. You can actually use these cost figures to work out what your initial cost of investment is going to be. You have your fixed operating cost for the lifetime of the project. You have what your expected revenue is supposed to be. So don't forget to break down when you work out what the total the total energy generated per annum is. Don't forget to adjust for your different clients. So 50% will be at 140 naira, then 30% at 120, and another 20. Well, I suppose you could put 50% at 120 and then 50% at 140, so you don't have so many columns. Importantly, obviously, is to make sure that you adjust your price each year for the price escalation. So a simple addition to your formula to multiply by 1.07 on each additional year should just help you do that adjustment easily. So when you put that into Excel, you should be able to work out this net present value and as well the internal rate of return. Don't worry so much about the equity rate of return. Just do your normal rate of return like we explained, which should give you this project rate of return. So if you work out what the negative net present value would be and then find out what the discount factor equals to 0, which should be 17%, that should match up with that nicely. Payback period as well, this should be easy to calculate using this, the cash flows, expected cash flows, and the total cost of the system. Don't forget as well to adjust for the fixed operating cost. I would probably advise that maybe you treat the fixed operating cost as your O&M cost. Okay, so that will just fit into that formula nicely. Okay, I just got a few questions to leave you with, something for you to just think about. Pretty much we've covered all these today. What are the advantage and disadvantage of the payback method? Can a solar PV system with an expected life of 25 years but a simple payback period of 40 years likely to be a sound investment? What do you think? What is net present value and how is it calculated? And what are the decisions ruling the use of internal rate of return? Okay, thank you all for joining us on today's webinar. As usual, it's been fantastic and I have all of you on board. We look forward to seeing you again real soon. All the best.